A very important decision for most all of America is expected in 48 hours. I'll give you the details here of that in this video. Also, Congress is grilling Treasury Secretary Janet Yellen and the Fed over its decisions on the banking failures and banks failing. Is your money safe? Well, we don't know. Take a listen to this.
On Monday, President Biden called on Congress and regulators to, quote, strengthen the rules for banks to make it less likely that this kind of bank failure will happen again, end quote. Secretary Yellen, thank you for being here today. Do you agree with the president that we need to strengthen our banking rules?
Well, I think we certainly need to analyze carefully what happened that triggered these bank failures and re-examine our rules and supervision and make sure that they're appropriate to address the risks that banks face.
Okay, so we want to make sure we've got the right rules in place. And pretty obvious, we need some stronger rules here. So I want to talk about those rules, the stress test. Stress tests are critical tools in the regulatory toolbox that are designed to expose banks' vulnerabilities if bad things happen and force the banks to shore up any weak points before it's too late. Now, Secretary Yellen, when you were implementing the Dodd-Frank regulations as Fed chair 6 years ago, back in 2017, you said, quote, our stress testing regime is forcing banks to greatly improve their risk management and capital planning, end quote. But you warned that because, quote, we can never be confident that there won't be another financial crisis, it is important that we maintain the improvements that have been put in place that mitigate the risk and the potential damage, end quote. So I want to talk about those stress tests that you talked about, how important they were 6 years ago. Secretary Yellen, can regular, rigorous, well-designed stress tests help bank regulators spot problems lurking in banks' balance sheets and business models?
Yes, I continue to endorse the comments
Good.
you quoted. I think this has been one of the most important and consequential improvements in supervision since the financial crisis.
So,
But
two thumbs up for stress tests. Let me just ask, when regulators spot these problems early on, can those regulators then require the banks to clean up the problems long before they trigger a run on the bank?
Yes, and in that sense, they're useful, but I would like to make one point.
Sure.
Which is that the supervisory stress tests focus on capital.
Yes.
And not on liquidity. And in these bank failures, liquidity played an important role.
And this is why, from an independent study, nearly 200 banks for trillions of dollars could be at risk. And look at this. There are 186 banks across the country that could fail if half of their depositors quickly withdrew their funds, like what just happened here with the failure of SVB Bank, Silicon Valley Bank, and we just had the second largest and the third largest bank failures ever in the history of the United States. And according to a new study published on the Social Science Research Network, found that 186 more banks across the country could fail if this exact same thing happened. And get this, even insured depositors, those with $250,000 or less in the bank, average Americans, could have problems getting their cash if these institutions face the sort of run on the bank that SVB Bank saw a week ago. Wow. The concern is that these banks hold a significant amount of their assets in interest rate sensitive financial instruments. That's the key there. Interest rate sensitive. And what is the Fed doing with interest rates? Like government bonds and mortgage-backed securities. Remember the 2008-2009 financial crisis with mortgage-backed securities? And what are mortgage rates? What have they been doing here over the last 12 months? They have doubled in interest rates. The value of those older low interest investments have dropped sharply as the Federal Reserve hiked interest rates over the past year. Yeah. In the case of SVB Bank, the Santa Clara, California-based institution parked much of its cash in long-term government bonds, which were deemed safe, which the ultra safe in terms of losing the initial investment, but were not worth as much when SVB bought them because interest rates have since gone higher. So because the bank couldn't hold them till maturity because investors wanted their money now, the bank had to sell off some of those bonds to meet customer demands to the tune of billions of dollars for withdrawals at less than it paid for them, resulting at a nearly $2 billion loss. So you can see how the Fed, Jerome Powell, the head of the Fed, and the board of directors at the Fed who keep raising interest rates are actually helping cause large banks to fail and are actually causing millions of Americans to fail. If you watched my previous video with Senator Elizabeth Warren actually grilling Jerome Powell about why he wants to cause over 2 million Americans to lose their jobs, because this is literally in Jerome Powell's financial plan, saying that 2 million jobs will be lost by raising interest rates. He says it's basically the lesser of two evils. It's a tough job. It's a tough job. Don't get me wrong. If I was there, it's tough because you have to deal with inflation or people losing their jobs, because when you raise interest rates, businesses go out of business because they can't get access to capital. The interest starts bearing down on them. They're paying more for interest. Access to credit cards is more expensive. People paying interest on their credit cards more expensive. Every time you use credit is more expensive. It's a tough cycle. It's a tough cycle. But on the other hand, if you don't raise interest rates at least somewhat, inflation will stay higher for longer. Yeah. So here and now, the Fed is now expected to have their meeting here in just a mere matter of hours. And how the banking crisis throws a wrench into the Fed rate hiking. Are they going to continue to raise rates? Are they going to stop raising rates? Some people think that they actually might reverse course here sometime in the near future, in the next few months, and actually start lowering rates because of this problem. And also because the government is paying billions of dollars more in interest. So everybody's paying more, and it's hurting us all financially in the long run. So as you can see here, they're meeting, the Fed, today and tomorrow. So within less than 48 hours, we are going to hear from the Fed and know what their decision is going to be on, are they going to continue raising rates and potentially make this banking crisis worse? Are they going to take that risk? Because we're literally seeing multiple banks already fail. And if they own treasury bonds, if they own mortgage-backed securities, do they really want to push that even further? And it's a dangerous game they're playing right now. It's a dangerous game they're playing right now. And we're seeing the domino effect here of people getting very worried about this. And if they raise interest rates again, this could cause another run on the banks where people rush to withdraw their money. So honestly, the safest decision for the Fed would be to not raise rates this time around. I mean, they've already raised rates 8 times here in about a year. Do they really need to raise rates again? The answer is no. Should they stop? The answer is probably yeah. Anything that's interest rate sensitive, like mortgages and car loans, personal loans, have already taken the sticker shock from interest rates. I mean, when you go to get a mortgage, I mean, they've gone from 3% or under to 7%. I mean, when you go to buy eggs, they're not interest rate sensitive. The grocery store doesn't say, oh, we've lowered the price of eggs because interest rates have gone up. Right? I mean, when you call your electric company, do they say, hey, we've lowered or raised the price of electricity because of the interest rates? No, they don't. So anything that's interest rate sensitive has already been affected by everything, by the Fed. So I think they should stop. I think they're playing with fire here. It's very dangerous game here at this point. Our financial system could literally have a meltdown here. So let me know your thoughts here, and I will keep you up to date here. We're on very dangerous thin ice. And we'll see what happens here. So if you appreciate these videos, don't forget to hit the thumbs up button for us, and make sure to click the subscribe button down below and the bell icon after you do, so you don't miss out on new videos. It's the best price of all. It's completely free, and I don't want you to miss out on new videos. Here's some videos you should watch next. Here's that video with Senator Elizabeth Warren grilling the Fed head Jerome Powell in a must-see video. Or here is NATO and their plans to put 300,000 troops on the border of Russia. Yeah, so click on one of those videos next. Thanks for watching, and I will see you in the next video.